4:07 p.m. We can go ahead and call the meeting of the Board of Trustees of the Murfreesboro Community Investment Trust to order. And we will start with the first item on the agenda, which is to open up the meeting for public comment. Do we have any public comment? Okay.
Everybody wants to talk.
Okay. Hearing none, we'll move on to item number 2 on the agenda, which is the approval of the meeting minutes. Did all the board members have a chance to read those?
Approval?
Okay. Got a motion? Second? Okay. It's been properly moved and second. All who approve, can you signify by saying aye?
Aye.
Those who oppose? Minutes have been approved. Item number 3 on our agenda is the fiscal year 26 budget. Craig?
I will defer to Ms.
Ms. Tucker.
Yes, we laid out a revised budget for you on your desk. It's just a little bit different from what Craig sent y'all last week. The City Council has already approved a summarized version of this budget so that we could continue funding operations starting in July with our fiscal year start. The revenues and expenses that you see here agree in total to what Council approved, and this is in line with what we budgeted last year. So we recommend this for approval, and if any amendments are needed, we can do that later in the year. I do not foresee that, though.
Okay. I reviewed it earlier today. Any of the board members have any questions about the budget?
Can you remind me what USB fees?
The U.S. bank fees, where they're being held, I think it's just the trustee fees.
Yeah, it's trustee fees. Sounds like a thumb drive fee.
Custody.
Trustee, yeah, custodial. trustee.
Custodial, yep.
Aaron, just for clarity, and I think I know the answer to this, but I'll ask the question anyway. Under, of course, the FY26 budget line, where we have the distributions of 2.7 and 490,
Right.
that's what we approved last year, but we're paying it out in FY26. That's why it's here, right?
That's correct, yes. That's based on the December 31st balance of 2025 to be distributed in FY26. So it could be distributed, I believe the city's distribution can occur anytime, but the charitable distributions can't occur until July 1.
Okay, understood. Any other questions? Hearing none, can I get a motion to approve this budget?
So moved.
Second.
Okay, been properly moved and second. All who approve, can you respond by saying aye?
Aye.
Those who oppose, the budget has been approved by the board. Moving on to item number 4 on the agenda, review of investments. We have Mr. Tim Burdick here. Tim?
Okay, thank you, everybody. I'm supposed to give my signal. I have 4 items. 3 are included in your materials. I've got 1 page extra just with updated market values because they're a lot higher, and I thought I might show them. Talk about the markets for a bit. I've got a June 30th performance report to review briefly. I'll update those market values as of a couple of days ago. And then I have an asset allocation study with a recommendation to make 2 small changes to the policy going forward. So I'll start with the market environment. And since we've met, a lot has happened in the markets. If you remember, go back, it seems like April was a long time ago when the tariffs were announced. The market at that point over the couple of weeks went down 18% and then came right back. So that by, as you see here on the right-hand side, year to date, so this is through June, U.S. indexes are here at the top. The S&P actually was up 10% in the second quarter. Again, this is a quarter where it dropped 18%. It just came all the way back very quickly to be positive 6.2 year to date. Of the U.S. indexes, the only one you see that's negative is small cap, indicated here by the Russell 2000. Small companies are still, they're being penalized in the market. This is an overgeneralization, but number one, because not sure how the tariffs are going to impact their businesses, that may have a more substantial impact that they have a harder time working their way through. And then number two, Economic data is somewhat mixed out there right now. If there is a recession, small cap stocks tend to get hit harder. Small cap companies tend to get hit harder than large cap companies. So there are other reasons, but for those two main reasons, managers are seeing that small stocks are underperforming larger stocks. On the non-U.S. side in the middle, I boxed out these two numbers, 19.4 and 7.8. Your international stocks this year so far are up over 18%. They're doing extremely well. A large portion of it is because the dollar has become significantly weaker. That's 7.8 are international stocks in their own local currency. So the difference is the currency translation, the foreign exchange as we come back to the U.S. dollar. It's come down a little bit since the end of the quarter, but here at the end of 6/30, it was 11.6% on average. So a good thing as an investor, not good if you're traveling overseas. If anyone who's been overseas, the weak dollar doesn't help you there, but does help from an investment perspective. And then bonds on the bottom of the page have had, again, a bit of a whirlwind over the last few months, trying to figure out what the Fed's going to do and all the dynamics around it. But it's settled into a decent rate of return. Bonds halfway through the year being up 3-4% is actually quite solid. I've got some pages I'm going to go through fairly quickly, just give you an idea of when we meet with, about 15 investment managers at the company on a daily basis. So we get a lot of input about what they're thinking about, what they're doing. From an economic perspective, a lot of the conversations come back to jobs. And we know what happened with the overall jobs number and the revisions and all the politics around that. But what has been being mentioned more and more is small companies. These are companies with less than 50 employees. Normally, across the country, those companies add 40 to 50,000 jobs a month. It's a big engine in the U.S. They've only been adding about 5,000 a month so far this year. It is a very stagnant, under the surface. The unemployment rate is still low, participation rate's also low, but the underlying numbers show that it's a very stagnant job market, which is concerning. It definitely has the Fed's attention. I mentioned interest rates. Green is last year, blue is this year. Interest rates have come down on the short end a little bit as the Fed has reduced the discount rate, interest rates a couple of times. The market is basically priced in 2 Fed rate cuts this year. One in September, one in December. Again, it's speculation whether it happens or not, but with inflation, more inflation numbers came out today, still being around 3% and being pretty stubborn to come down. That's making the Fed pause. It should be dropping because the job market is weaker. But it's fighting inflation, and just stubborn inflation that's not going down. And as Powell has indicated with some of the tariffs and the implementation over time, that is modestly inflationary. So they have to monitor that as well. This is the U.S. stock market broken down by its various sectors. The orange here, the bars on the left, you can see that the recovery in the second quarter was led by tech. It was the Magnificent Seven again. It's the stocks you think of. Even the two sectors, communication services, that's Alphabet. Consumer discretionary, that's Amazon. It is those large companies that really drove the recovery of the market. So in the first quarter, value was in play. The market was sort of figuring itself out. After the tariffs, they decided the tariffs weren't going to be an issue, and the market recovered. It went right back to the large cap. It went right back to the tech stocks, where it has been for a few years now. One of the positives here to take away, why is the S&P up this year? This green is earnings growth, blue is dividends. So the 6% that the stock market was up in the first half of the year, none of it was PE expansion, none of it was valuation expansion. It actually did match up very well with actual earnings growth and the dividends that they paid out. Not what you see in Europe, where almost all of the growth was, again, currency impact that I just mentioned, as well as valuation expansion, just stocks becoming more expensive. So the European market has gone up a lot. That's been more speculative. The U.S. market, what it's actually gone up this year net, actually matches up very well with earnings so far. I mentioned the dollar obviously has helped us out so a lot this year. Just a quick reminder that all of these were negative last year. The dollar, if you remember, strengthened significantly in the fourth quarter last year, so that was a headwind. It reversed itself. Now we're seeing the tailwind side. So when you see that international's up 18% this year, a reminder that we gave the market some of that money last year. We're just getting it back. Don't know why our research group made this one black and white, but maybe because the information on it's not very positive. This is expected or projected GDP growth for around the world. We're sitting at about 1.5%, which is really just where we were in the first half of this year. GDP numbers, as you know, slightly negative first quarter, 3% in the second quarter, but extremely muddy. Import exports, enormous shifts in exporting and importing over the first couple of quarters really made those numbers a lot less predictive. But overall, U.S. at 1.5%, but you see Europe at 1%. Japan less than that. China was running at 10% for decades. They're now looking to be a little bit under 5%, which is causing them some challenges. So across the globe, expectations of global economic expansion are pretty muted. A positive, institutional real estate. You have an investment here with Ballard. Right now it's about 4% of the portfolio. The target is 5%. Real estate in general has turned positive, but not by a lot. You see over the last couple of quarters, it's been about a 1% return per quarter. It's generally just been income. The real estate market is still not very liquid. Institutional on the large side, it's really all private assets. There's just very little transaction volume this year. So it's impacting not only the real estate, but your private debt, your private equity. Nothing is in trouble. There's just not a lot of transaction volume going on. Not a lot of mergers and acquisitions. You do have some infrastructure with JP Morgan. I actually just met with them in person yesterday for a while. They are very bullish, and it's really about this theme. There is a growing demand for energy in this country. I think we all know about it or have heard about it because of data centers, because of AI and other things. Essentially, the energy utilization in our country was flat for the last 2 decades. We needed more, but we became more efficient. And they pretty much washed each other out, as you can see on the left-hand side of the chart. On the right-hand side, it doesn't feel like much to say 3.9% per year, but you do that and you multiply that out, that's 70% over the next 15 years. It has definitely become one of the conversations that just keeps coming up with managers, not only in infrastructure, equity managers, bond managers on the private equity side. They're constantly bringing up energy, how to develop it, how to put it in places where companies can utilize it, the transmission, making it more efficient. That is one of the big themes that's really out there right now. And what I mentioned, there's not a lot of transaction volume right now. This is PE-backed companies and how long the private equity funds are actually holding these companies. I'll end here. It's because there's less volume, because there's fewer transactions, private equity, and you'll see this with Partners Group, there's just not transactions. And transactions are generally when most of the money is made. So when you don't turn your portfolio over, you do have somebody pricing it every quarter, but they're going to be pretty conservative with those estimations, with those valuations, until the asset's actually sold. And without the sales, what we've seen so far kind of across the board are 5, 6, 7% private equity returns, which are much more just valuation and not actual gains. So it's a bit challenging on our side to get a good idea of where the portfolios are at, just because we're not seeing the transaction volume. What this all turns out Your portfolio, and this is again, as of the end of June, stood at $68.5 million. We are, again, keeping it very close to the policy targets. With the market, stock market, somewhat richly valued, as it goes up, we are doing some rebalancing to keep you close to targets. That's one of our responsibilities. We're not going to let this get too outside of its range on the asset allocation side, especially on the upside. As the markets did as well as it did in the second quarter, we were pulling some of that down and rebalancing. Really, the only thing that's outside of target, and I've mentioned it many times before, Golub, your private debt manager, they took half of the funds when we first hired them. They have not drawn anything since then. Again, it's a slow market. They don't need the money yet. There's not a lot of deals out there. So we just talked to them last week, and they are like everybody else. They just don't see the visibility right now. I always enjoy my clients' charts when the line is going up, as this one continues to, but I think the numbers down at the bottom, again, we've been managing this for about 14 months, so it brought in $53.5 million, 7.3 came in net. The portfolio is earned in realized and unrealized gains about 7.66 million to come up to that 68.5. So again, that was one of the real conversations we had when we were first funding this, was to have a decent first year, to have positive returns, to make sure that this was heading in the right direction for the community. And through the first 14 months, it has been. Those numbers, and let me go to this one. Total fund. You can see, again, the second quarter was quite good, up 6.4%. That was all the return year-to-date, calendar year-to-date, you're up 5.6%. Again, we've been running this only for about 14 months, but since inception on an annualized basis, just under 10%. So it's been obviously a good time in the markets. Don't need to go through the managers specifically. I can answer any questions that you have, or try to. You see a bit of red here on U.S. equity. It's not necessarily that the managers are underperforming. It's just you see the difference between large cap stocks being up 15.8 since we funded them, small cap stocks being up around 2%. So that diversification has not worked so far. We're patient. Things tend to even out over time, and more of your money is in large cap, obviously. But that underperformance really isn't manager related. It's the fact that you do have some small cap stocks in your portfolio. International, again, has been surprisingly good thanks to the dollar, up 18.8% so far this year. And again, over the time, 15.4, so well exceeding any expectations. Hedge funds using the parametric fund, again, the 14 months up 10.4. As I mentioned, real estate's been positive, but not by much. So it's good to see a positive number come out of it, but there's not a lot there. Better days are ahead. Infrastructure, we'll talk a little bit more about in a minute. With JP Morgan, as I said, I just met with them yesterday, 10%. We've been working with them now for 12 months through June. So in the first year with them, they're up 10.2. And then, as I mentioned, on the debt side, this is a half allocation. Wish it was a full because the Golub was up 9.8 last year. And then partners, again, without the transaction volume, just not positive returns, not a problem, but not as much as we're going to expect to see. We're expecting that to be a 9-10% return over time. Only other page I'll hit on here, because it's relevant to a conversation in a minute, is just a reminder. This portfolio in its original composition is very liquid. Even though you are cash flow positive, so you don't need this money and won't for the next decade, literally 83% of it is available on a monthly basis. So on our allocation system, it actually kind of pulls a red flag and says there's too much liquidity here. So when I make my recommendations to change the asset allocation, keep this in mind, because we actually want to bring that liquidity down a little bit. Nothing tremendous. We're not looking for big moves. I just saw this morning. So it is not in your packet. But this market value reflects the inflow, and it's a much higher number, so I thought it'd be worth sharing. So as of August 12th, the portfolio had just over $80 million in it. Now, if you look down at the bottom of the page, there's about $3.5 million in cash. We have raised that for the payments the outflows are going to be happening over the next couple of months. So we've got that set aside in cash. So again, this is probably a peak. This will probably go down over the next couple of months if markets stay flat to 76, 77 million range. But again, a whole lot better than the 66 I just showed. So. And then finally, as we indicated when we started, we would complete an asset allocation once a year around the time that the funds were to be brought in and added to the trust to take a look at the asset allocation and see if we wanted to make any recommended changes. The study is based off that $68 million market value that you had previously, target rate of return 7.5, and again, a spending policy of 5. So that's the basics. These are the asset classes that you're currently utilizing. Our software, we do not calculate or estimate these rates of return. These are annualized returns over the next 10 years. These are numbers that the system generates. It does its own modeling based on 25 underlying characteristics. Most of them are lower than long-term averages. S&P large cap core is an example. The system is saying on average it's going to earn 7%, 7.1 on an annualized basis over the next 10 years. If you go back to when the Dow started in 1929, the average is more about 10%. So that's showing the rich valuations and some of the other challenges that are going on right now. Data specific, this computer doesn't read headlines or make guesses that way. It's looking at it from that perspective. But you see a lot of numbers, not many returns from asset classes that are over that 7.5% benchmark. So it is, not yourself, all clients in general, all institutional funds right now are a bit challenged to make sure that they are close at least to that close to their investment targets. The clients that we have at 8% right now are really struggling with to put together an asset allocation that we both want to recommend that they actually utilize that'll generate that 8%. Because if you're looking at 8%, you're basically in privates. And you don't want to have too much there. You want to have some, but you don't want to have too much. This is down at the bottom, this 9, 10%. So the recommendation that we want to make today is to make 2 changes to your portfolio. The first is to reduce bonds by 2.5% and add it to infrastructure, to the JP Morgan infrastructure fund. So you're taking out of the public bond markets where, again, those expected rate of returns are 4 or 5, put it in infrastructure. That JP Morgan fund earned 10 last year. Over the last 20 years on average, it's earned about 8.5. So from our perspective, we're taking a small part of your portfolio, 2.5%, and taking it that's going to earn, say, 5 to 8%. To us, that's a value add. You do not need, one of the main reasons you have investment grade bonds in the portfolio is for liquidity reasons. You do not need that much liquidity. Because again, your net cash inflows, there really isn't a scenario over the next 10 years that we would need to draw down anything significant out of the bond market. Again, this is just a portfolio that runs a little differently than most of them that I have to work with, where liquidity is more at a premium. The other recommendation is to take 2.5 out of the stock market, U.S. equity from 40 down to 37.5, and put it in privates. So 2.5 from public equity markets to private equity markets. This is really based on the idea that valuations in the stock market are high. S&P is about at a 50% premium to long-term averages. You could make the argument it's different it's different this time. AI is going to add to corporate earnings. The market showed it because the market had an opportunity to correct itself with the tariffs in April when it went down 18%, and then it just went right back up. So the market's comfortable with this level of valuation, probably more comfortable than we are. So this isn't a big move. This isn't take all your money out of the stock market. But if you take 2%, 2.5%, again, something that we think is going to earn 7, and put it into something that we think is going to earn 10, again, that's accretive over the next 10 years. So, and again, as I mentioned, from the liquidity perspective, so you're taking 5% from something that's from 2 asset classes that are very liquid to 2 asset classes that are much less liquid. Both infrastructure is quarterly liquid. The private equity is going to be will have annual liquidity. But that's not an issue within this portfolio. Again, you're going from 80% or 83% liquidity, monthly liquidity, down to 78. So it's really not having, that's not a material impact. Our asset allocation software tells us to do a lot more. I know this is a conservative group. I'm a conservative investor at this point. I want to do this incrementally over time.
Tim, can I ask you a question, please?
Sure.
Is the execution of this basically just taking the Shankman and just taking the 2.5% from Shankman, and that reduces credit, high yield bank loans, and global aggregate all by those specific amounts?
Pretty much, yes.
Because we don't have a credit or a high yield fund.
Correct.
We have high yield through.
What we did is we took Shankman and we broke it out into the 4 pieces.
Yeah.
So we could, it's better to model that way. So absolutely. The only reason I say I hesitate on that is because we're underweight a bit to Shankman right now with the additional dollars. So from a policy perspective, yes, 2.5 would come from Shankman. But if you look at the market values as of 2 days ago, we're underweight Shankman by 1.2%. It's up on the screen now. So we're underweight by almost $1 million there. So when it actually comes to funding these managers, we'll move the targets to the targets in option A. That's what would be in your revised investment policy. But in terms of actually what dollars we're going to move, we'll rebalance the portfolio. And we'll take from whoever is above their allocation. But yes, from a policy perspective, you would see Shankman go down by 2.5, and you would see each of your U.S. equity managers go down by a bit, 1.5, 1.5 and a half. Just to
Remind me on the JP Morgan, we have a version of that's an evergreen private fund.
Yep.
Is that this one, or is this the public traded fund?
No, this is the Evergreen Private.
Okay.
Couple of data points I thought might be of mild interest. Cash flow summaries. This is what we're projecting to be the net cash inflows into this portfolio on an annualized basis over the next 10 years. So we're taking the cash flows for the spreadsheets that were provided to us, and we're taking out that 5%, but we're accounting for the expected growth each year. So again, that's the net cash inflows that we're anticipating. Here are the spending projections. If you look at the 50th percentile, on average, it works its way up to 13.2 million at the end of 10 years. Yep, absolutely.
When do those payments hit?
We get them July 1. You're talking about from the MTE?
Yeah.
Yeah, we usually get them right around July 1. And
So did we just make a contribution?
we just put about 10.5 in.
And you guys already just kind of spread that out into this as it shows right here in the current?
Yeah, what it shows right here. So we spread out most of it, but we left that $3.5 million in cash for expected distributions, which are numbers we got from the office, so.
Gotcha.
Can you go back, I'm sorry, to that cash incoming, you're saying that's the cash coming in?
That's net of cash, that also accounts for cash going out.
Oh, that's net, okay, I'm
Yeah,
sorry.
that's net.
Okay.
So again, if any other questions, obviously, please jump in. Otherwise, our recommendation is to
Yes,
change the asset allocation from what's current on the screen to Portfolio A. Again, moving fixed income down by 2.5, U.S. equity down by 2.5, increase infrastructure by 2.5, and private equity by 2.5, so it'd be a total of 5% move.
Still within policy.
It is within policy, but I would recommend updating the investment policy, just so that we've got it, I'll update it, we can bring it to the next meeting, just to make sure. You can make these moves and still be in compliance, but I would rather update the policy once a year, do a revision, and make sure these are current.
But we should do that anyway.
Kind of my thought is do the asset allocation. If you approve, then I'll update the policy and we'll move to the new targets.
So will we also be adding money to the partners group?
We actually would not. We're going to bring in a second manager. If the committee approves, it'll probably be a firm called Pantheon. It'll be a similar structure, though, where it's an evergreen fund. We're not going to be in evergreens forever here, but with the lack of activity in private markets, if I give it to a direct manager, they're just not going to draw the money. So it's going to be another Golub where I make an allocation and the money doesn't move. So our thought is to utilize get the diversification with a second evergreen private equity fund. And then when the markets open up over the next couple of years, we'll start to move some of this money from these evergreens into more traditional private equity. But it allows us to get to the new target allocation right away.
I'm going to throw something out here for the committee to think about a little bit, just in terms of, and I don't even know, are we able to access like direct investments, like private direct? SpaceX, for example, is raising money again through Franklin Templeton's arm, intermediary or whatever. I mean, like, would we have?
Yes, you have the ability through your investment policy and through the asset allocation to invest directly into private equity funds. So basically the three vehicles are these evergreen funds where you invest into a current portfolio that's existing and ongoing. You can do a fund of funds where your manager will go out and pick 30 or 50 directs, or you can make the decision to go out and invest in direct funds where you go to a specific manager, invest in their private equity funds, 7 if you will, and have them make, say, 10 to 15 to 20 individual investments. Right now, we've got you in the most conservative, most liquid side in evergreens. But again, with these cash flows and with the portfolio growing over the next 10 years, you should have the capability to start to move into some other assets where we think you'll get some additional return over time.
So what I'm getting at is the one company kind of direct, so it's not a drawdown structure, it's just we're putting capital into basically that company, a private company.
You would, if it's a private company and a direct, and it's only a single investment,
Yeah.
I don't believe your policy would currently allow you to do that. You would still need to go through a manager, a Franklin Templeton, or someone who has a fund that's currently out.
It's not a fund.
It's a straight along.
Franklin Temple just owns SpaceX, and that they bought privately, internally.
Private placement.
So it's like, it wouldn't be a private placement at the level that we would buy it at now, but maybe originally. So, we can think about that later. I'm just kind of curious, but.
Tim, even if we were to approve your recommendation, we would still be neighborhood of 60+% liquid, or?
You would still be correct. You would be, Shankman is monthly. Yeah, I mean, say if you would combine the daily and the monthly, you'd still be 78% of your assets we'd be able to liquidate within a month.
And I mean, in the evergreen structure too, it's fairly liquid. I mean, it's not like it's a real private.
Yeah, right.
Where they're leaving 20% sleeves in cash so that we could liquidate some of it if we needed to. So
But it
We're
feels
way
like,
liquid.
to the point you're making, it feels like based on the structure of what we're supposed to be spending this money on anyway, I don't know if we would need a whole lot
No.
of cash at one particular point in
No.
time unless it was
Not
some natural
liquidity.
disaster or something, the council did something, so.
No. Again, the way it's structured, the money's coming in before the distributions are made. So we're just leaving part of that incoming cash as cash to make those distributions. So we know we're net in each year.
And it doesn't sound like, well, I mean, I think we may be taking on a certain level of risk, but nothing super risky here.
No.
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 Based on the way you describe the private funds that we're currently invested in.
Correct. Yes, obviously, there's some risk involved with any investments other than cash, but on the spectrum of where institutional investors are, you're still leaning a little bit conservative, even with this change.
And I will just kind of say for what it's worth, that the quicker we get, even with the drawdowns being maybe limited with some companies that you guys use or whatever, or that y'all lean towards, I would say we want to get towards the direct private stuff as sooner rather than later, just for this is my opinion on it. The illiquidity premium is a little bit better. You've got the full investment going in. On the evergreen stuff, the deal is, the reason that they're more liquid, like I said, is they're only investing 80% of the money-ish. And so you only got 80% of your money making money. And so if your expected, return on this private investment is a 19% net or whatever, it's never going to be that way in the evergreen side. So, the faster we can go on and get into those, and we don't need the liquidity at all. And so, it's kind of, to me, if we're going to be at 80% anyway, if we go ahead and start the process on some of the drawdown stuff, I think we should probably go ahead and start that process sooner rather than later if we can.
Okay.
Just my opinion on it.
Let me go back and
Talk
review the
more.
policy, when I do the policy update, and make sure that from the language that's acceptable. I'm sure it is.
I'm not talking about, you're talking
Oh,
about.
and I'm not talking about making big changes or things. I'm just saying, we can start to look at that. Just in general, rules of thumb, evergreen funds around 10% return. That's a reasonable expectation given their history. If you're in a fund of funds, great diversification, but 2 layers of fees, 12 to 13% is a general expectation. If you're going to take the risk and go into some direct funds and head down that path and build a portfolio that way, the returns you want to be about 15% net. So there is, as he's saying, there is a premium, there is additional money to be made there. Our idea was, again, if we came in last year and said, let's do this and let's do it versus via directs, you wouldn't be 5% invested in private equity right now, you'd be 0.5. So evergreens allow you to make the allocation, start earning that 10% on average. But over time, let's take some of that 10 and turn it into 15. So that's like another way of saying it.
Yeah, and you also, the way that they evaluate those funds, we'll call it, it's not a very good word for it, but the way that they would evaluate that sleeve, it's not a daily evaluation out there on the open market, through an auction. It's very smooth, and so when the market goes volatile, those tend to not be nearly as volatile when we get our quarterly reports, because they're privately held and they're not transacting a lot of shares back and forth very commonly at all. So they tend to stay much more stable. So that would be kind of a big part of my lean towards that as well. And I recognize the drawdown thing might take some time, but we may be in that scenario for a while and put it off, and then we're 5 more years before we ever start to build that process. You see what I mean?
Oh, yeah. No.
I'd say I'd rather get to that point and go ahead, and if we have some drawdown money sitting aside, we can always pull our drawdown money from bonds.
Oh, absolutely.
So it's not like it's just got to sit there in cash.
Right. And if you're making a direct investment, you tend to make small allocations, say 1%, because you don't want to put all your eggs in one basket, if you will. So you make a direct investment or 2 each year, and you build a portfolio that way.
Yeah.
So if it's a 1%, target, if we're looking to go out, let's say, what would 1% be, $750,000 in a fund? That's Yeah, it's a rounding error as they start to draw down money, so it's easy to create the liquidity in bonds.
Yeah, so like KKR's has an offering right now, that's their new fund. And it's a drawdown, so I mean, you commit a certain amount of money, and they're going to go out and start buying companies in the mid-market space. And it might take a while for us to get that commitment made, but that's.
Yeah, the investment period is usually, for that KKR fund, is 5 years.
Yeah.
So you make a commitment, say $750,000, and they'll draw it down in pieces over the next 5 years. Yeah, we can look
It
into
kind of
it.
looks like we're looking for a higher risk premium on some of these investments.
That's exactly what it is. You're moving up on the risk chart, but you're with the idea of expected higher returns.
Exactly.
But also not necessarily all the volatility.
But how often are these private assets valued?
Quarterly.
Quarterly, that's what I thought.
It's
Fees are
valued
higher
differently.
as you go up on the risk, is that accurate?
Yes, the fees are going to be a bit higher. The incentive fees are a lot higher. That's the old 2 and 20 model. It's not 2 and 20 anymore, 2% fee and a 20% performance fee. It's come down from that. But yes, if the managers, if the funds do well, the managers are generating something like a 3% fee. More partners would be a 1%. So they are incentivized to make money.
Is that the direct funds or the fund
They're
funds?
direct.
Okay, what other questions do we have for Mr. Burton? Based on his I think that's agenda item number 5, his allocation recommendation.
That's right.
And I don't know if I,
The motion for that?
yeah, we need a motion for approval.
I'll make that motion.
Can we get a second? It's been properly moved and seconded. Any other questions?
Do we need to ask about the investment policy change, or does that come later?
That will come I'll bring that to the next meeting.
Next meeting?
Yep.
Excuse me, thank you.
We'll approve that next meeting.
Is there any chance that, and I'm sorry, just on discussion here, but is there any chance that, like, from the standpoint of if we're going to increase our private numbers today by 5%, is that right?
2.5.
And 2.5?
Yes.
So if we increase our private stuff by 5% today, is that going to hinder us from being able to do new direct stuff
Not at all,
because of the cash coming in?
because the cash comes in all the time here.
Got it.
Can I just confirm what the motion was for? Was it to confirm the recommendations to reappropriate the allocations? Is that what's being
Based
done?
on Marquette's recommendation, yes.
Okay, perfect,
That's
thank you.
correct. Okay. All in favor, can you respond by saying aye?
Aye.
Those who oppose? Okay, it's been approved. Thank you for that recommendation, that report, Mr. Burdick.
Thank you.
All right. Do you have anything else you want
No,
to share
sir.
with the board?
That's a conclusion of my report. Thank you again.
Much appreciated, and all the good work you and the firm do for us. Other business. Craig, do we have any other business? Any board member?
We don't, but bleeding into the next one on future meetings, did you want to talk about what we had talked about?
I do. Craig and I had a brief conversation a few weeks ago. We were just kind of looking at the market and everything that's going on currently with some of the volatility and headlines and things like that that Tim was talking about. And we thought what we need to make sure that we're doing is meeting at least quarterly to make sure that we have a chance to discuss and look over thoroughly the returns and things like that we're getting in our report. I know when we first started, we were meeting monthly, but I don't know that that cadence is necessary. But, even based on privates being valued quarterly and things like that, it'd be a good idea. And I think most boards do meet quarterly to make sure that everything's in good shape and we have a good understanding of what's going on. So if everybody's okay with that, I don't think we need to take any action, do we, on that? But we try to make that a tradition to meet quarterly.
Yeah, we'll get Brenda to start surveying on a quarterly basis and
Okay.
finding a date that works for everybody.
Excellent. Thank you. Good.
Matt, along that same line there, I know everyone at this table is very, very busy. I make a recommendation that we come to the next meeting with potential future meeting dates so we can go ahead, like right now, I don't want to, it would be too arduous to go through and how does whatever this date look like today. But if in the agenda, there are potential future options in there, and perhaps we go ahead and fill those out via email today. I just feel like, one, it's a challenge to get us all in the same room at the same time. So if we could do that as far in advance as we could, and maybe when we come in here, we're not scheduling our next meeting, we're scheduling the one after that, right? So we have the next 2 meetings on the calendar, and potentially have a meeting, primary meeting, and then like alternate A if somebody's schedule just doesn't permit and we have conflicts. At least we've already thought about, not next meeting, but the one after that, a primary date and a secondary date. And the sooner we can all get these holds on our calendar, I think the better off, and the greater the likelihood for us to get in here quarterly. I think that's kind of where we miss out is I think our calendars probably fill up a month in advance, and then you never know when the earnings call comes up, or family vacation, or you got to drop off the kids at college and those things. So my recommendation is try to plan these things out in far in advance as possible to get us all in here. I think that would help, this group. I feel like it was a big undertaking to get this meeting put on the agenda.
Yeah, I'm good with any of that. I'm gonna make a statement here, just tell you for what it's my opinion on this, because I do this a lot and sit in that seat a lot, and quarterly is a lot. And realistically, I'll tell you, like, most of the time, it's so incremental little changes that have happened. There's really not, sometimes when you do this quarterly, I mean, if we just could wave a wand and we were all available on April 3rd and July 3rd and October 3rd, a couple days after the end of the quarter, and he could have our stuff ready, it starts to get where you lack stuff to talk about, because you don't have, it felt like we were here it feels like we were here the other day, and it's the same numbers because they hadn't had a lot of time to change. That's going off a different kind of viewpoint. I'm glad to be here quarterly, and I'm totally cool with it. I do know also, though, that we have points in time where we have to approve the budget, and we have to approve the distributions and all those kinds of things, that if we could somehow, like, if we do this where we could coordinate, I guess would be the right word, when those should happen. I think we missed our time on this one. I think we were a little late on this, right? Is that, we were trying to get that.
Next time, I think it'd be great if we did at the same time that y'all approve the distribution. And there's no reason why we couldn't most likely have a budget at that same time in the spring when y'all are looking at that, because that's usually what, March, April, when y'all are looking at that?
Yeah, March, April is when, well, the committee has it to you by February 15th. Their recommendations to you by February the 15th is what's required. And then somewhere after that is when you can approve it. We went long, which is not a problem because we don't disperse until later anyway. But I think Aaron's right. The biggest stress point here was not having a budget that was approved. We got over it with having council just approve a budget. If we did it somewhere at least around March or April, early March or April would be a critical meeting to meet the dates that you're talking about.
Yeah.
The additional dates, of course, we can fill those in at any point in time, but that's probably the biggest one.
I think, well, so if we can wrap that into one meeting, then it really, I was thinking if we already have two kind of coming that are maybe in kind of different times of the year, that I guess what I was trying to get is, I think if we got to 3, if we just set a goal to get to 3 a year for sure, and if we had other reasons to have them other than necessarily just like the quarterly specific stuff, I think that would probably, we could take care of business that way. But if you guys want to do it quarterly, I'm not complaining about it at all. I'd be totally good with it. I'm just kind of saying sometimes it gets a little redundant because literally you go these quarters. And you're right, a lot has happened this quarter or in the last 5-6 months, call it. But that's not necessarily true in a whole bunch of quarters. I mean, we're going to come in and everything's going to we're going to not be able to tell the difference between the last time we were here. And it's, just as hard as it is to get us together. I'm good with doing it, you guys, but you kind of mentioned if we get it to 3 at least, I'd be cool with it. And if we want to do 4, I'm good with it too.
My opinion is, in light of the recent volatility in the market and kind of anecdotally what I'm hearing from business owners, right? There's going to be more volatility, and there could be some challenges and strains in the market. I would almost rather have those meetings on the agenda and cancel them.
Yeah.
That's what I
good.
was going to recommend.
The items.
Yeah, that's a good point.
And us guarantee, if there was volatility, if we did need to get together and have a vote, I'd like to have it on the calendar.
We do that with the city's pension committee. We have a standing monthly meeting, and there have been years when we've met twice, and last year and the year before, I think we met probably 10 times, so, but we can, we get information from our investment advisor and take a look at what decisions need to be made. If there's no votes that are needed, then we send out the quarterly reports for the committee to review so they can see it, but we're not going to waste everybody's time pulling them together if there's nothing to vote on or really discuss. So that's a great idea, having it set on the calendar for y'all and then cancel if it's not needed.
That's good.
Probably just need to decide if we're going to cancel before the public advertisement and public comment.
Not a
those things, but-
problem. It's not a problem.
It gets canceled.
Yeah.
Meetings get canceled all the time
Yeah.
Okay.
on
Excellent.
that. But just to reiterate, though, probably that March, April 1st meeting
Yeah.
is the most critical one. And then after that, we'll hold that meeting almost every time, just because we need the decisions.
And Stephen, any thoughts on?
I like the last idea of going ahead and setting up probably quarterly meetings, have a fixed time and cancel if you don't need it. That makes sense. And one of those obviously fit in the time frame that would give the allocation.
Sounds good to me.
Good deal.
Thank you, appreciate the feedback. Okay, future meetings, item number 7 was the last on the agenda. Does anybody have anything else we want to discuss before we adjourn? All right, I guess was it 4:59? My eyes aren't what they used to be. We're officially adjourned. Thank you all for your time.